Well, many Wall Street strategists spent much of the year making ever higher predictions for the S&P. They even stuck with them through August turmoil, but many of them are now cutting their forecasts, including those at Citigroup, Goldman, and also Wells Fargo. For more on the markets, we were joined this hour by JPMorgan Funds Chief Market Strategist David Kelly, and also, of course, Dominic and John joining in on this conversation. And I know you're reluctant to give forecasts, but you do have one for the S&P,
well,
right?
I'm reluctant to give short-term forecasts because, honestly, long-term investors need to remember that they're long-term investors. And it's so exciting to talk about what the market's going to do between now and December, but if you're retiring, 10 years from now, it really doesn't matter.
But as a strategist, they look to you for some sort of forecast.
Sure, so obviously as the markets have come down and as we still have no real resolution in Europe, and as economic forecasts have come down, we have had to reduce our estimates. So, at the start of the year, I roughly thought we could get to S&P 1400 by the end of the year. Now I think we can, we'll be happy to get to 1300 by the end of the year. I still think the market can go up between now and the end of the year, but the real issue is right now we've got a lot of macroeconomic headwinds, but valuations are very good.
Right.
So I think a long-term investor shouldn't get too obsessed with what the market does over the next few months. It's going to be a bumpy ride.
Well, David, bumpy rides aside here, we do know that people have been focusing intently on earnings for the last couple of quarters, and rightfully so. They've been good. Corporate profitability is way up there at record levels. But now no one cares about earnings, right? No one talks about them anymore. Right. Everyone talks about Europe. At what point do we have to wait until Alcoa kicks things off again before we care about earnings? Or even then do we not care and we just focus on Europe?
Well, I think markets will probably move more on the European story for obvious reasons. But the earnings story is still good. And I think the key with earnings is, do we see slow growth, which is actually a reasonable earnings environment? And earnings will, I think, continue to grow if we do 2% growth over the next year. Or do we see a recession? A recession will bring earnings down. But the level of earnings already more than justifies what the stock market is by a lot.
Let's go back to retirement first. Say you are somebody who's retiring at the end of this year, and you're looking at all the money that's piled into the bond market, and you're nervous because you own a lot of bonds. I mean, what do you say to people who are retiring as of the end of 2011 about where their money should be?
Well, first of all, remember that the average person who turns 65 today has got a 5% chance of making it to age 100. So if you want to be 95% you're not sure that you're not going to outlive your money.
A 5% chance.
If you average between men and women, based on mortality, the average person with the 65th birthday today has got a 5% chance of making it to 100. And the key is, the market risk isn't the only risk. There's a big risk that you're going to run out of money. If you're so lucky as to live that long and don't get your money to grow, you're not going to get your money to last. So the first thing I'd say is, do be worried about being overly weighted towards fixed income. Have a balanced portfolio which is appropriate for where you are in life.
Let me get back to the short term, though, David. Yeah. You said something right at the beginning that you do think that we can still rally from here on to the end of the year. Why is that? Is that the Fed?
Well, no, certainly not the Fed. I think the Fed is really reached the limits of what it can do to help the economy. The Fed might be able, this week they may do Operation Twist to try and push long-term rates down. Does anybody really believe anybody in America is hesitating to borrow money because rates are too high? No. So it will have zero impact on the economy. But
apparently the Fed thinks that it would help if they did it, though.
I think the Fed doesn't want to give people the impression they're powerless because people don't have any faith in the economy to grow by itself. And so I think they're trying to operate on confidence here, but I think the best thing to do is let people know that this economy has the capability to grow without more stimulus from Washington, either from the Fed or the federal government.
Okay, so getting back to the point then what's going to rally?
I think just a lack of bad news, and I think what's going to happen is we're going to have various eruptions from Europe, but eventually, Europe is a lot better at fire departments than smoke detectors, and eventually, when, as these things hit the fan, Europe is going to the ECB, I think, will be more aggressive in buying sovereign debt. The Europeans will do more to try and figure out, can they actually get the Greek economy to grow again? Because if they can't get the Greek economy to grow, it will eventually default, and that's a very it's a very expensive proposition.
Okay, so basically it's a lack of bad news then.
Eventually there'll be a lack of bad news, we hope.
All right.
Markets will go after them because they'll say, well, if they can't stop Greece from defaulting, if they can't bail out Greece, then surely Italy and Spain. So the plan that the Europeans are working on is keeping Greece from defaulting for a couple of years. They can't stop it permanently.
Can't stop it permanently. That was Martin Feldstein, and we are back with JPMorgan Chief Market Strategist David Kelly. And you agree with Martin?
I think there's an easier way to do this. The key thing to recognize is that Greece is a very small economy. It's about GDP about $310 billion. Okay? What they need to do is give Greece the money. All Europe has to do is give Greece a grant of, say, $15 billion per year for each of the next 3 years to get their economy growing.
But they're giving them the money. What do you mean?
No, they're lending them the money. There's a big difference between a grant and a loan. And because they're lending them the money, their debt to GDP ratio is going up, both because their debt's going up and their GDP is going down. You've got to stabilize the economy. This austerity after austerity is like bleeding a patient to make them stronger.
But what message would that send to other nations if Greece gets the money?
It doesn't send a great message, but clearly. But it's I think Europe in the long run, Europe's going to have needs more of a fiscal union. And I think they do need to get some long-term structural guarantees from Greece about retirement ages and the size of the civil service and what it's going to do in the long run. But stop shrinking the size of the Greek government right now. Austerity will not work. If you shrink the GDP of a country while its debt goes up, it will eventually default. And it's much, much cheaper. $15 billion a year over the next 3 years is very cheap.
It's going to cost even more to bail out the banking system
much.
in Europe.
Well, I mean, here's the problem right now. There's so many strategists, so many analysts, so many investor surveys have said, you know what, there could be a partial breakup of the euro. Is the system inherently flawed for the shared currency, where this is just a failed attempt at what's postponing the inevitable?
Well, I think there is a big flaw in the system, in that if you've got a single currency but you don't have a big central government, you're not going to have the normal transfers that would come to us from a central government when a region gets into trouble. Everybody's on their own, and that is a big flaw in the system. And I don't think they're going to get to full fiscal union anytime soon. But in the meantime, as a substitute for that, just like we sent money down to Louisiana with Hurricane Katrina, the federal government did effectively in very large amounts. We should recognize that Greece has got an extraordinary problem. The cheapest thing for everybody is to help Greece out for a few years in return for long-term structural agreements, get their economy growing. That'll get the people off the streets in Greece actually pulling for the European Union, and then work on a common long-term fiscal strategy to get these big debt numbers down in Europe in the long run.
Okay, and in the interim, then obviously stabilize the markets.
Well, and the ECB needs to buy more bonds. The European Stabilization Fund needs to be used to backstop the banks. There are other parts of it, but the first thing is get the weakest economies growing again.
For Chicago now, where John Brady, the senior VP of MF Global, is standing by. And John, we are selling off right now. The Dow off by about 170 points. Is this mainly the concerns out of Europe?
No, Betty, it is. Unfortunately, over the course of the weekend, this economic finance ministers meeting yielded little, if anything, new in terms of policy or policy direction. So what we'll see is we'll continue to see sovereign spreads widen out. CDS prices, i.e. insurance policies on sovereign debt, continue to richen, and we'll see the European banking sector continue to lead trade lower. At the end of the day, this whole idea of perhaps trying to leverage up the EFSF is most likely going to be the most viable option for European policymakers, but it's going to take some time. So again, the markets are nervous here in the fact that very little came out of Europe this weekend. Is
that something that could calm the markets, the stability fund?
I think it'll help, but we're going to continue to have problems as austerity causes economies like Greece and perhaps Italy to shrink. But I think it will if the Europeans make more of a commitment to backstop the banks. If the sovereign debt's okay, the banks are okay. So really, I think we need to focus on the sovereign debt problem more than the bank problem. But I think in temporarily backstopping the banks.
And quickly, David, back here at home, confidence. You said we need more of it, and we need it from the Fed or whoever. How do you get it?
Well, I think we need policymakers to let people know that this economy's got everything it needs. This is an engine flooded with liquidity. It's just lacking a spark of confidence. So let people know that we've got everything we need to grow. And I think that's part of that is saying we don't need another fix from the Fed. We don't need another fix from the federal government. We've got a lot of pent-up demand. There's a lot of cash on the sidelines. Just tell people they can do it themselves. That's where it really starts.
John, would you agree with that? That the markets would actually like to, that they don't need another fix from the Fed?
I think that's right. I think really at the end of the day, entitlement and meaningful, significant tax reform are probably the two best paths by which to reignite consumer and business confidence here in the United States. Hopefully this week, the U.S. Senate will pass some of these free trade agreements and at least give a glimmer of hope that the political logjam in Washington, D.C. will come to a temporary cessation. But at the end of the day, I think it's tax reform and entitlement reform which will give businesses the clear path. There's much talk today and this week about the housing market and the weak housing numbers that we'll see later on this week.
Right.
Mortgage rates only down 40 basis points, where longer dated treasuries are down 100 basis points.
All right.
We need reform.
I point out this story, David, because, as a retail investor, when you're watching people like John Paulson, these guys who made a lot of money during the housing crisis, who've, had great returns, even they can't seem to get it right in this market. That creates that amount of fear, and that is why you're seeing these retail investors yank their money out of equity funds. That's why you're seeing them not get into stock markets.
Well, that's right. And let me clarify, though. I do think the economy is going to be very soft over the next 6 to 9 months anyway. I mean, I still think there's about a 25% chance of recession.
But you don't see a recession, though.
I think we will probably avoid a recession, but I think there is a bigger risk than was a few months ago. I don't want to sound too optimistic here, but I am optimistic for long-term investors if you're investing for 5 years out, 10 years out. And I really think that's the difference between professional investors and individual investors, because individual investors often do have time to ride out market cycles. If you're a big hedge fund manager and you have 2 very bad years, it can have a huge impact on your ability to do business. So I think longer-term investors just need to remember they're longer-term investors, because in time, both valuations will improve, and I think the economy will get better.
But I think what frustrates the average investors, they hear strategists say, time to get defensive, and they say, well, thanks a lot. I could have used that advice a year ago.
Exactly.
And John Paulson, at the very least, is trying to see those opportunities because the stock market has been selling off. So what's the balance, David? I mean, where would you put your money that isn't the obvious defensive place, but might have some upside if people decide to buy stocks again?
And that's where you have to be a little bit brave here, because right now, PE ratios are quite low, are very low, in fact, and we think that over time, as the economy improves, PE ratios go up. So what's going to do best? Probably higher beta stocks. If you're a long-term investor, be balanced, but I would actually say things like technology, consumer discretionary, even financials, I think will over the next few years.
So even without a lot of confidence out there, some retail
without
stocks,
short-term confidence, but fear is the major factor in our environment today, but fear has been priced in a very major way. We've got real 10-year treasury yields, even using core inflation, of 0. And we've got the lowest PE ratio, or lower PE ratio today than we've had at the end of any quarter since 1990. In fact, if you look at stocks and treasuries combined, I believe stocks are cheaper relative to long-term treasury bonds than they've been since the 1950s.
Well, David, let's talk about interest rates right now, because during the commercial break, we had a very interesting discussion about one prescription that you would have for our economy to get people to start investing again, and it's a pretty controversial one.
You've got to think about the psychology of the economy. To me, almost the definition of recession is when people want to wait and see. And almost the definition of recovery or expansion is when people want to do it now. The best thing the Federal Reserve could do, in my opinion, is to say that they will raise interest rates starting in 2012
because that'll
and 2013.
get people to invest.
Absolutely. If I told you that the best 30-year fixed-rate mortgage rate you could get in a year is 5%, and in 18 months it's 6%,
I'd buy a home
You'd
now.
buy a home now. There's a lot of people who are capable of investing money, taking advantage of low rates today, who aren't doing it because the Fed has told them there's no hurry. Finish your breakfast, take your time. They're not going to raise rates at any time soon. Monetary policy is most effective at stimulating the economy when you've got low rates, but you're threatening to raise them. That's when monetary policy gives the economy the biggest kick, and I think the Federal Reserve is entirely wrong promising low rates forevermore.
So you think that Bernanke should broadcast that?
Well, I don't think they're going to. I think yes. I think the Federal Reserve's got to get away from this orthodoxy that somehow promising low rates forevermore helps. The psychological message tells you don't need to do something, and we want people to spend private sector money, take advantage of low rates right now. But if you promise them low rates forevermore, why should they?
And we all know that people.
But how credible is promising? I mean, I'm just saying, how credible is it when you've got an environment like this for Bernanke to come out and say that we're going to raise interest rates when? I mean, at this point, I mean, is there even an economy that justifies higher interest rates right now? No.
Oh, I think that there is, because I think the problem is that people are languishing in this low rate environment. A promise of higher rates actually will stimulate people to jump the gun.
In other words, negative reinforcement will work better than positive reinforcement.
Exactly. Just if I was selling oranges in the street corner, okay, and you came up to me and said, are there going to be any oranges around tomorrow? I'd say, no, this is the last of the oranges. Buy them now. I mean, any retailer tells you take advantage of a deal right now. Everybody's hesitating in this economy. Everybody's waiting to see. We've got to give people a reason to do it now.
Okay. All right, David, on that note, thank you.